This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt. To move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
High-stakes visit. President Trump meets with German Chancellor Angela Merkel to seek common ground and resolve tensions over trade.
Heart health. A new cholesterol drug cuts your risk of a heart attack, but it's raising a new debate about cost.
Lost and found. A few working moms had a simple idea to help keep track of things their kids kept losing, and they turned it into a multi-million-dollar business. Those stories and more tonight on Nightly Business Report for St. Patrick's Day, Friday, March 17th.
Good evening, everyone, and welcome. We begin in Washington, where the head of the world's largest economy met with the head of Europe's largest. President Donald Trump hosted German Chancellor Angela Merkel at the White House in their first face-to-face meeting. The two discussed jobs, business, security, and at an afternoon news conference, the focus was trade.
I am a trader. I am a fair trader. I am a trader that wants to see good for everybody worldwide. But I am not an isolationist by any stretch of the imagination.
Earlier, the two leaders and business executives, both American and German, held a roundtable discussion on how companies can better train workers. Why was this meeting important? Because the economic relationship between the two countries runs deep. Germany is the U.S. fifth largest trading partner. Exports to Germany from the U.S. totaled about $49 billion in 2016. Imports from Germany hit $114 billion. Eamon Javers reports tonight from the White House for us. Good evening, Eamon. And what did we learn about the future trade relationship between the U.S. and Germany?
Well, we learned that both sides want to continue to engage in this relationship, and they're talking about baby steps here at the White House today. You remember there was so much tension between these two nations because President Trump, during the campaign, insulted Angela Merkel several times, saying that she was ruining Germany and she was ruining their economy, and he didn't know what she was doing in terms of bringing migrants into that country. So today was a day all about sort of mending those fences and moving this relationship past that. And I think on those terms, you'd have to say that this was a success today. Both sides got the opportunity to deliver the message that they came here to deliver.
One of the points of sort of question points has been about NATO and the European Union and how the two powers relate on that. The president was really direct in his support of NATO. On the European Union, not so much.
Yeah, that's right. And he was also direct in his request for European nations to fund NATO, right? One of the problems that the United States has had over the years is that they feel that European countries are not contributing enough in terms of defense spending to support NATO. The president had the opportunity to deliver that message to Angela Merkel directly today. In fact, we were told by a senior White House official before the press conference even began that that's what the president had said behind closed doors. So that gives you a sense of how important that was to the White House to let the world know that message had been made. And also we heard Angela Merkel have the opportunity to tell the president that it's better that we talk to each other than about each other, perhaps a veiled reference to the president's criticism of her on the campaign trail last year.
Yes, indeed. We mentioned the earlier meeting that included CEOs from IBM, Salesforce, as well as a number of CEOs from German companies. What was accomplished?
Well, it's not clear what was accomplished specifically, but they got the opportunity to highlight something that's important to this White House, which is the idea of apprenticeship. And in fact, you even heard the president during the press conference joke about The Apprentice, his former reality TV show. This is something that the White House thinks the United States can learn from Germany. A lot of the blue-collar training, vocational technology training in Germany is done through apprenticeships, and they think American companies can really learn something here about educating workers of the high-tech workforce of the future. They want these American and German companies to be talking about this, and they want to see what the lessons can be learned are here for the United States.
Eamon, thank you so much as always. Eamon Javers at the White House.
You bet.
On Wall Street today, stocks limped into the weekend with a mixed finish, dragged lower by financial and healthcare shares. The Dow Industrials fell 19 points to 20,914. NASDAQ was up a fraction after hitting a new high mid-session, and the S&P 500 was off 3. For the week, the major averages eked out small gains.
Manufacturing output expanded for the 6th straight month. According to the Federal Reserve, the 0.5% gain at factories matched the prior month's advance and marks the best back-to-back performance in 3 years. The report underscores the rebound in the industry, even though overall industrial production in February was flat.
A gauge of future economic activity accelerated to its highest level in more than a decade. The Conference Board's leading economic index rose for the 3rd straight month. Both business and consumer confidence have risen since the presidential election on the prospect of less regulation and lower taxes.
One of the biggest stock losers today was Amgen. Its new costly cholesterol drug was shown to cut the risk of heart attacks and stroke in patients with heart disease. Now that sounds good, but it wasn't enough for investors. And shares of Amgen fell more than 6%. And it dragged down the stock of other companies that make similar cholesterol drugs. Meg Terrell explains the disappointment around the study.
Millions of Americans have cholesterol levels high enough to put them at risk for heart disease. That's why drugs to lower cholesterol, like Lipitor, have been billion-dollar blockbusters. But some patients aren't helped enough by those drugs, called statins. That's why a new class of medicines that lower cholesterol even further, approved in 2015, was expected to bring in big business. Made by Amgen, Regeneron, and Sanofi, the medicine's sales disappointed in their first years on the market. Despite price tags of more than $14,000, they brought in just more than $100 million last year, versus expectations from some of billions. But new clinical trial results presented today were expected to change that.
Sales of this drug should grow from hundreds of millions of dollars to multiple billions of dollars over the long term.
Results from a more than 27,000 patient clinical trial showed that Amgen's drug, Repatha, reduced the risks of heart attacks and strokes by about 20%. The result? Amgen's stock sank. Investors' expectations had been for an even bigger benefit.
All of the data suggested 20 to 25% magnitude of benefit. The data ultimately showed a 15 to 20% magnitude of benefit, depending on the exact endpoints.
Proving a drug doesn't just lower cholesterol, but actually cuts the risk of heart attack was expected to encourage insurers to increase coverage, a key reason their medicines haven't been used as broadly as expected. Despite Wall Street's reaction, Amgen says the results are game-changing.
If the patients who are already FDA approved for this drug, which is on the market, had received it last year, if all of them had received it last year in the United States alone, we would have averted more than 100,000 cardiovascular events like heart attack and stroke.
And it expects that insurers and pharmacy benefits managers will increase reimbursement.
Now we have the data, they're crystal clear.
The drug maker even offered a unique deal. Amgen says it will refund the cost of the drug if patients have a heart attack or stroke. For Nightly Business Report, I'm Meg Terrell.
Still ahead, hot hand, our market monitor's fund has outperformed the stock market this year so far, and he's now buying stocks with a global flair. One of the most powerful forces in the market right now is the expectation of deregulation. Stocks have been moving on it. Corporate executives have been talking about it. We've already seen the president sign executive orders that target some of the rules governing the financial and energy industries, and we've reported on the potential impact. Tonight, we look at how scaling back rules and regs could impact the broader market and the economy. We begin with Bob Pisani at the New York Stock Exchange.
There are two components of the broad Trump rally: tax cuts and deregulation. Now, there are many studies that indicate cutting corporate taxes could increase earnings 8% or more, but studies on the boost from deregulation are much more difficult to do because of the tens of thousands of different laws out there. Just not possible to get a number right now. But no matter, let me show you why the street believes reducing regulations can help on earnings and its close-cut margins. margins are probably the single most important metric for those looking at profitability trends. Thomson Reuters says S&P 500 margins have been stuck in roughly the same range for the last several years, about 10%. Now, why can't margins improve at all? It's a big issue for the street right now. One of the primary problems is that sales growth has been stagnant. Well, the cost of doing business, the cost of materials, for example, and the direct labor costs used to produce the goods has been rising. That's a problem. This is where excessive regulations show up indirectly on the income statement. So if you look at big industrial names, Caterpillar, for example, fewer regulations will help drive down the cost of materials and labor. That goes right to the bottom line. And banks could see a dramatic savings from a reduction in their costs of employees. This could make a big difference in a company like JP Morgan. JP Morgan CEO Jamie Dimon has been railing for years about compliance costs. There's about 240,000 employees at JP Morgan. 18% of them are in compliance. Think about this. 1 out of every 5 people at JP Morgan are involved in looking at what the other 4 are doing. The Commerce Department just began the first of many salvos to reduce regulations on March 7th. They're asking the public for information on the most burdensome regulations for domestic manufacturers. You could submit comments on regulations.gov. You'll hear a lot more about this in the coming months, but you can already see why Wall Street is enthusiastic that a reduction in regulations is a second crucial aspect of the Trump agenda. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Most economists love deregulation, but figuring out if it will be a real growth driver is not an easy task. Steve Leisman explains.
To hear one side tell it, regulations are the difference between smog-choked city skylines and breathable air, between polluted rivers and clean running water. But to hear the other side tell it, regulations depress growth and kill jobs.
We have undertaken a historic effort to massively reduce job-crushing regulations, creating a deregulation task force inside of every government agency.
President Trump has promised to eliminate 2 regulations for every new one put in place. Professors at Duke and Stanford in a study suggest regulation may have cost the U.S. economy $4 trillion. Measuring from 1980 to 2012, they believe the economy could be 25% larger if regulation hadn't grown so much.
Increasingly, you have to hire people just to comply with the regulations. These are folks that are not producing the services or the goods where the profits come from. So what our research shows is that there is now almost an unacceptably high cumulative cost of regulation. It's a burden.
The study found a massive rise in the number of restrictive words in the federal code. Words like shall, may not, and prohibited. These words now top 1 million. From under 600,000 in 1977. But the professors acknowledge they didn't look at the positive side of regulation. They agree that health benefits from cleaner skies and safer workplaces and food may not show up in most growth measures.
You know, you really can't find deregulation impacts in prices or growth. And it's really, really important not to forget the benefit side of the equation. And that's often missing in the research.
To critics of deregulation, the financial crisis of 2008 is the best example of the cost of going too far and loosening up too much. $11 trillion of wealth was lost, in part because financial derivatives and banks had been heavily deregulated. The bottom line is economists believe regulation can keep out competition, raise costs, and reduce productivity and growth. But they also will say there are benefits to regulation that should be counted before regulations are written off. For Nightly Business Report, I'm Steve Leisman.
Strength overseas helps Tiffany sparkle, and that is where we begin tonight's market focus. The luxury jeweler said strong sales in Japan and China, along with higher prices, helped offset weakness in the Americas. Tiffany acknowledged improvements still need to be made, but still gave an upbeat forecast for the year. Shares up nearly 3% on the session to 92.42. Meantime, the enterprise software company MuleSoft, yes, MuleSoft, went public on the New York Stock Exchange today, opening at $17 a share. The company isn't profitable yet, but says it's confident in the future of its business.
Our biggest thing is that we are a recurring revenue model. So all of our software subscriptions are annual or sometimes few-year contracts. And then we renew those contracts with our customers and expand them dramatically over time. So it's that land and expand model for our business that helps us be more productive from a sales and marketing standpoint.
And a nice debut it was. Shares soared more than 45% in their market debut. They finished at $24.75.
Biotech company AstraZeneca said the Food and Drug Administration rejected its medication intended to treat high levels of potassium in the blood following an inspection of the company's manufacturing facilities. This is the second time the FDA has turned down the drug due to manufacturing issues. Separately, AstraZeneca said it was partnering with a British pharmaceutical company to develop and sell 2 respiratory drugs. Shares were up a fraction to $30.69. The private equity firm KKR and a Canadian pension fund will jointly acquire Onex's USI Insurance Services for about $2 billion. That deal values the insurance brokerage at nearly $4.5 billion. KKR shares fell 1% to $18.16.
Our market monitor this week is a stock picker who's finding opportunities in some global names he thinks investors are missing out on and are misunderstood by the markets. He's David Marcus, Chief Investment Officer of Evermore Global Value Fund, up more than 8% this year, beating the market and his peer group. David, welcome back.
Thank you.
You have some international choices here. Do I infer from that that that's because you simply like these companies, or because you think non-U.S. markets are better priced than the U.S. market is?
It's both. The fact is that the U.S. market has been hitting all-time highs day after day after day. But that's not the case outside the U.S., especially in Europe. And so you can get global players with huge growth opportunities at value prices by buying ones that are based in other markets, like Europe.
And you are a long-term investor. You look for cheap companies, but some of the stock picks you're giving us have really decent dividends, too. But you tend to hold on to your holdings for quite a while.
Absolutely. We're not traders. We are investors. We take a long-term perspective. We don't get rattled by short-term issues with companies. We really take a long-term view, because companies that are going through change and transition, it takes time for their value to really get out to the shareholders.
So let's get to your stock picks, starting with Vivendi, a company that is really a media company. NBC used to have a relationship with them. How long? Tell me about it, and how long would you expect to own a company like that?
Okay, so Vivendi is a big media conglomerate. It's based in France, but it actually owns Universal Music, which is the largest music company in the world, which is actually a U.S. business. So they have assets all over the world, and we've owned it already about 4 years. And you
still love it?
I still love it. It's one of our largest holdings. There's just so much opportunity. It was very undermanaged for many years, and new managers came in, and they've really been restructuring and refocusing. And that's a theme that we absolutely love, which is change, that is taking companies that have been mediocre managed and bringing in higher quality managers. So Vivendi is a perfect example.
Your next stock is Marine Harvest. It's a play on change, but dietary change.
Yes. Yeah, so this is the largest salmon company in the world. So the consumption of salmon is growing really exponentially. And so there's not enough fresh salmon out there, so people get it from these large farms. And the fact is, you have a 10 PE, so it's 10 times earnings. You have a huge dividend, over 6%. And this is the biggest one, and it swallows up some of the smaller players in the industry.
Where's it domiciled?
In Norway.
In Norway. I'm not stunned to hear that.
I even went to the fish farm to check it out.
My Norwegian. So, okay, there's nothing fishy about that one. Let's move on. Had to. The last one is Scorpio Bulkers. I assume it's a freight company.
Yeah, so this is a dry bulk carrier, and they're moving goods, dry goods, not oil, between basically U.S. and China and back and forth. And the fact is, when China started to slow down, this whole industry was decimated.
Right.
So at that point, we started looking at the carnage, and Scorpio is really a play on a turnaround of one of the best players, but also as global growth starts to materialize again, this is a perfect example.
Very quickly, I just saw that stock has tripled over the past year. It still has room to go?
It does. It's actually our largest holding today, and we are very happy owning it.
Money where your mouth is. David, thanks. As
Thank
always, good to be with you. David Marcus with Evermore Global Advisors.
And coming up, what started out as a small basement business turned into a multi-million-dollar venture. The story of how a few hard-working women made their millions.
By using an old-fashioned stick-to-itiveness, a group of working moms created a niche business and tapped into the multi-billion-dollar global label market, which is expected to reach, get this, more than $43 billion by the year 2020. Their unconventional struggle from startup to brand name on tonight's How I Made My Millions.
Rise and shine. Time to get ready for school.
To keep track of her kids' stuff,
Let's go.
Julie Cole puts their names on almost everything.
Give me your water bottles, dudes.
A formidable task for all 6 of them. It helps that she's a co-founder of the multi-million-dollar company Mabel's Labels, based in Ontario, Canada. A business idea born in the early 2000s when Cole, her sister, and another mom, frustrated that their toddlers kept losing things, couldn't find durable labels.
We saw masking tape, we saw permanent marker, and we just kind of thought, you know what, there's got to be a better solution.
So they reached out to Tricia Mumby, a friend who worked in printing.
I thought, this is ridiculous. Tell your kids not to lose their stuff. Until you are in this parenting situation, you don't realize this is a problem.
Even before she became a mom herself, Mumby agreed to help. And the 4 spent about 2 years researching how to make sticky labels.
That would go through the dishwasher, the microwave, be UV resistant.
And they did it while working full-time and raising families.
My partners were persistent about it. They really wanted to try something on their own, really just as an add-on business.
All they really needed was a workspace, some printing machines, and money. But they decided against outside investors.
We were 100% cool with being like, hey, can you do me a solid? You got to help us out. We're doing a startup. We're bootstrapping.
We did a lot of bartering for things. Like our website was built in trade for a foosball table.
And we ran a production facility out of my sister's dingy basement.
In 2003, Mabel's Labels launched online, selling packs of 45 durable, personalized labels for about $21 each. They received about 10 to 15 orders a day, and then out of the blue, hundreds at one time.
So I called the foosball guy / website developer and said, we have a virus, what is going on? And he looked and he said, there's no virus, those are orders.
Turns out their product had been featured in an email newsletter, and things really started to stick.
I remember making myself count to 5 and then hitting F5 for refresh, and more orders would come in. It was crazy. And we had to call in sick to our day jobs for days and days afterwards to make these labels.
Within 4 years, this part-time business became a full-time job for all of them. They moved out of the basement and into this 14,000 square foot facility. And by 2016, Mabel's Labels had 40 employees and sales of about $9.5 million Canadian. That's nearly $7.25 million US bucks. It caught the attention of one of the largest specialty packaging and label companies in the world, CCL Industries, which made them an offer.
They really understood our brand. They had been watching us for a long time. So we sold the company for $12 million.
That's more than $9 million US dollars. Cole has continued to run public relations while Mumby became general manager. But their 2 co-founders cashed out. Now the business pumps out hundreds to thousands of label packs a day, depending on the season. And it runs almost 24/7.
There's something really special about starting this and building it and selling it and knowing that you did it all without a single loan. I really do love to make labels.
Mabel's Labels can be used on practically anything from sports gear and luggage to shoes and phone skins, and some even include barcode technology. In case you lose it, it needs to be tracked. Cool.
I could use that for my kids.
Cool, very cool.
They're losing things all the time. That's Nightly Business Report for tonight. I'm Sue Herrera. We want to remind you that this is the time of year your public television station seeks your support.
And I'm Tyler Matheson. Thanks so much for your support. Have a great weekend, everybody. Happy St. Patrick's Day.
Yep.
We'll see you Monday. Here's the green, so am I.
Yep. Color coordinated.
Nightly Business Report has been funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.